Doug Shreve, good morning.
Howdy, Keith.
Howdy. Talk to me, Doug. What are we howdying about?
Well, we're howdying because yesterday I went to see my friend, Dr. Dermatologist,
Doctor Dermatologist.
and I wear this hat to remind all my friends out there on the internet to wear a hat this summer if need be. If you have skin like mine, a nice hat like this one, or maybe one of your choosing, will give you some shade. And I highly recommend some sunscreen. I prefer this sun bum stuff, probably because it's real expensive, and I believe the more expensive it is, the better it is. But I happen to get a good deal on this, and it's just nice stuff. It's just nice. So wear your sunscreen, wear your hat, all of those things, and your dermatologist will appreciate it.
Well, even along those lines, aren't there brands of clothing that even have
Oh,
sunscreen in them?
Keith, when I go to the beach, I look like a beekeeper. Um, yep, I've got all that stuff too. And I still get something scraped off my body every other year because I've been told the damage began in the 80s.
Wow. I was traveling this last few days at the end of last week and beginning of this week in Florida, and along the way, I noticed 2 and 3 story dermatologist buildings there everywhere.
I mean, when we go to we've got the like canopy tent thing.
Okay.
I mean, I don't know why I go to the beach.
It's like you could have been at the sauna, right?
Yeah, yeah.
What a beautiful day in central Indiana today. I love it. I love it. Well, Doug,
Libby and Amanda are making fun of me. I'm not only do I have sensitive skin, I'm a sensitive person.
well, I think I'll stand up for you, Doug.
Thanks.
You be all right.
Thanks a lot.
Yeah, yeah. So you were wanting to talk about a certain brand or types of investments today, and I my thought was we talk about them from a very low level area before we go to the high level. Like we assume, and we don't want to insult your guys' intelligence. We assume you don't know anything. It's what I thought we would talk about as we begin, and then build forth where you could maybe have a more complicated conversation with us if we wanted. And so the two ideas you said you were curious to talk about were bonds and small companies that are publicly traded. Which one do you want to jump into first, Doug?
Well, I think it's a great question. Is keep sending a text. Hey, what do you want to talk about today? And what has been intriguing me in the marketplace are bonds and small companies. Bonds have been intriguing me mainly because we've used cash as a resource for the last couple of years. In 22 was not a great year to be a stock investor. And what worked? Well, money markets worked fairly well. They went from in July of 2022, I think the Fidelity money market was paying like 1.3% or something like that. And today they're up around 5. And so it's been a decent holding place for people. Cash has been treated fairly well lately.
Well, let's stop there. Let's talk about what is a money market. Like, it's a term that I think a lot of our followers probably use, but maybe they don't even know what that word means.
Yeah.
Yeah, because if you compare that to, say, a savings account at a bank, your savings account is generally going to be FDIC insured for $250,000 based on the title of the account. And then there's if you've got money at a savings account and you want to make sure it's federally insured, we've got, I think, a link we can send you and you can punch in your bank information. But is a money market a federally insured thing?
It's a great thing to talk about and keep because money markets made the news this week. There was a judge who didn't really understand that what a money market was. And so it's a great thing to talk about. And it is different than a savings account. At the bank, a savings account, the bank may take your deposit and loan it out to other people. for an auto loan or a mortgage or a personal line of credit, and then they're going to get a little higher interest rate off that and maybe pay some to you, right? That's what you kind of hope for. With the money market, I like to think of it as a souped up savings account. You're going to traditionally get a little more interest, but you are taking on some more risk because it is not federally insured, or it's not Federal Deposit Insurance Corporation. Is that what it is?
Yeah.
It's not FDIC insured. It's going to invest in short-term IOUs to other places.
Right. They could be IOUs to the federal government. It could be, short-term treasuries, but it is, they call it the buck, break the buck. If the value, if you look on, I don't know where you look anymore. You used to have a newspaper. You could look at money markets and they'd say $1 is the price.
Like
So,
$1 per share.
Yeah, $1 per share. And so back in 2008, the concern was, and it was a real concern that they would break the buck, which means that your money market would now trade at 99 cents a share, which doesn't seem like a big risk, but it freaks out the whole economy if that happens. And there's been a few money markets in history that have done that. I noticed an article this week that said the money center banks are bleeding deposits. So did you see that article? Yeah, so you can, if you shop the bank you're using to try to get FDIC returns, you can probably get a 5% savings account at a bank. Most of the money center banks are paying 0.01% still. And so if you've got your capital sitting in a money center bank, my opinion is it probably should be bleeding from there. They should be paying higher interest rates. And so that's just Keith's opinion. So the idea of liquid money being a good place for people, it's reasonable, but the bigger problem we have, and we've talked about it many times, is inflation.
So you were asking about bonds, or I've been intrigued by bonds recently.
Yeah.
Which is kind of an unusual thing for us, or for me anyway. But I've just been intrigued by bonds to think about what does the future hold. And we've had some good success with money markets. What does the future hold for other fixed income assets? And we're still in, here's an industry term. We're still in an inverted yield curve, meaning those shorter term commitments are paying you more than a longer term. I would think, Keith, if you loaned me, say $10,000 for 10 years, I'm going to pay you a higher interest rate during that time than our lower interest rate during that time. If you offered me something maybe in the near term, because of where rates are, a short-term money market is right now paying you 5%, whereas a long-term bond is paying 4%. And that's not normal, right? Normally, you would get paid a little more for the longer term than you would in the near term. And so that inverted yield curve is out of whack. And at some point in time, it's going to change.
Normally, an inverted yield curve tells you the marketplace is expecting a recession. That's normally what an inverted yield curve says. But let me even step back a little bit and talk about what is a bond, because that term is used for a lot of people and they may not know what it is. And essentially, it's financial industry lingo for a loan.
Yeah, I like to think of it as an IOU.
Yeah, and so there's a lot of ways businesses borrow money. Like the short term is called commercial paper. There's
That's
bank,
like 200 some days or less.
could be, yeah, it could be really short. Then there's bank loans where they literally will go to, maybe one of the money center banks and borrow a bunch of money. And then there's corporate loans that are issued to investors either through the avenue. There would be a bond, a short-term bond, maybe a year or 2 or 5 or whatever. But those are issued and bought up either by individuals, but mostly today, I think they're bought up by mutual funds and corporations, maybe like other investors, maybe.
Right out of college, I had a really great start into the investment industry. I worked for a small company based out of Indianapolis. They were experts in writing tax-free bonds. The big guys couldn't compete with them, and I got to share offices with underwriters.
And tell me what an underwriter
The
is.
people putting together the deal.
So what would they do for a day? Like
Yeah,
what's an underwriter look like?
Okay, so they might go visit a school or a school corporation. That school corporation might want to raise some money. And so they might say, well, if we put together an IOU, we could get people to invest in this school corporation and we'll sprinkle them a little interest from time to time. And so uh, people love that because it's tax-free. It's helping their local community. And these guys, what they would do is they'd go out and say, hey, if we create this IOU, this gives people an opportunity to invest and gives you an opportunity to expand. And that's the same way with a corporate bond, a little different nuances, but it's basically an IOU.
Yeah, the municipal bonds, there's a reciprocal agreement between the state and federal government where the federal government lets cities and states and counties issue bonds and they allow them to be federal tax-free income. And all of that's really kind of interesting to me in a lot of different ways. When you were talking about it, when I was a rookie in the business, my manager asked me to walk across downtown Indianapolis to grab something there for him. And my coworker, who was a rookie like me, the two of us we're just meandering like lost souls from our office to this other place. And it might have been the Bank One Tower. I don't know what it was at that point. I can't remember what it was, but we finally get there. He hadn't told us how important this meeting was. There's a room full of attorneys that have been waiting for like 45 minutes for us to show up. And they hand us probably, like something like this thick. They hand us a stack of something. And we were both clueless what we were doing. And nobody gave us any instruction. And so Susie took the stack first and we're looking at each other. Then we kind of look at whoever the head person is around the table and like, this is our first, what are we supposed to do here? And that person kind of in a condescending tone said, well, I would count them to make sure they're all there.
Sounds like a good start.
Yeah. And so we were like, okay. And so Susie's over there going, she's doing this thing, like, with, kind of counting them. And, because there was a letter on top, how much this value was. And, so then she said, would you double check? And she hands it to me. And so I'm counting them. And I was off by like $30,000 or $50,000, but I was too immature to go, well, man, I need to count them again. And I just took the attitude, I'm just going to trust Susie got it right.
Yeah.
So we get out into the street and we're walking across downtown Indianapolis with what were called bearer bonds. And it was somewhere between $2 and $5 million of literal cash type assets. We're walking across downtown Indianapolis and we're laughing at each other at what happened in the room. And she looks at me and says, I had no idea what I was counting. I just counted how many certificates there were.
Oh my
And
goodness.
I said, we could both be fired by the time we get back to the
The
office.
certificate either was worth one or is worth 1,000.
Right.
We
And
don't
so
know.
that's
But-
how bonds were
but
issued in the day.
With bonds and with municipal bonds, whatever the bond is, a municipal bond, corporate bond, a lot of times the buyers are strong hands and they are banks. They have cash. That was the first phone call that many of the salesmen at this company would make is before it would even hit the opportunity for someone like me to buy them or my uncle to buy them, it would go to the bank first.
When you use that term strong hands, that's kind of an industry term where weak hands would be somebody that's kind of anxious about being in a market and that they're kind of the ones that a lot of times will lose money in investment transactions. And the strong hands are those hands that tend to be able to sweep in when the market's down and pick up assets at a bargain. And the terminology is a battle between the strong and the weak hands. And generally speaking, as an investor, we're trying to help you be strong hands. Like we're working on your behalf to not be the weak hand, to let things go or to buy things that aren't necessarily the best for your interests. So bonds are available in all different forms. Some of you may have bought savings bonds in the day. You may have a stack of them sitting in your savings box or your drawer or something.
That's all right.
Yeah, if you have those, it's probably time to cash them in, and we can talk you through that, but
There's only one way to do it these days too. That's a pain.
yeah, but bonds, if I was gonna show you, they're teeter-totter, so interest rates will go one way. So this end is the interest rates, and this is your bond value here. So if interest rates go up, you're gonna see your bond values go down, like Doug was saying earlier. And when rates start to decline, that's when you start making money beyond just the coupon or the interest rate that's attached to the bond. And I would say that's what we're waiting for, is to see that first time when the Federal Reserve starts to say, we think we're going to lower rates. What's your thought on when that's going to happen?
There's a lot of jockeying for position right now, and at the flip of the calendar, many speculators were calling on multiple rate cuts this year, and we just haven't seen it. And so there's been people get this wrong. And so my thought is just to wait on the market, wait till the market tells us. And that means that you probably miss out on a spike, an initial spike, but you might save yourself some grief and capital if it were to go the other way. And that's what we've seen so far this spring, is we've seen a lot of hype in the bond market, and then we saw some return of capital, I'm sorry, declining capital, and then now there's been some resumed interest in it. And so expectation wise, Keith, I have no idea. I have no idea. I think it's going to be really interesting. I don't foresee them raising interest rates, but I don't see them rapidly declining interest rates either. I think we're in a reasonable time. And if you go back and you take just look at mortgage type stuff. We had a good friend in this week. We were talking about this. Here recently, we're used to seeing 2-3% mortgages, but my parents saw 12-13% mortgages. 7's not too bad. It's not great. It's not horrible. It just is what it is. And really, if we look back in time, this is kind of normal. And so I wouldn't expect to see the Feds cut unless the games start to be played with the market.
When you're saying that, I don't think I've in my lifetime ever had a mortgage rate as low as 7%. So I don't know if that's like, you hear those old guys talking, but I've never had one that low. And so the idea of what's a reasonable mortgage rate really probably is relative to the economy you're in. Yeah, because we have friends that have bought their first house in 12, 13, 14% interest rates, and they survived to tell about it. And so what do you do in these kind of markets? You just kind of wait and see what's going to happen. A number of people that I trust are probably more pessimistic than what you express, like that there might be another kind of run on these things. And probably you don't know till the prices tell you, because the Federal Reserve, I thought it was the Federal Reserve, told us that this was transitory inflation, 2 years ago? And I think most of us know that our grocery bills are still a lot higher than they were 2 years ago.
We have to pay the price for shutting down businesses during COVID.
Shutting down businesses and turn on the printing press, and that's kind of where we're at. And I don't know if I don't know how long it takes for all that to actually, like, if that's like a snake eating an elephant, like how long does it take it to get to the system? I don't know.
Well, this is part 2 of the discussion, because I expressed interest in small company type stocks. You want to talk about that?
Yeah, so let me talk about that a little bit. And the industry language is capitalization, which I use that word all the time, not with you all, but with people in the industry that I know what that means. But I can remember in college, like, that was a test question: what does capitalization mean? And I'm like, I've never heard that word in my life. And so it's what capitalization means is, how do we finance this company? Like, is this company going to be financed with a loan, i.e. a bond, or is it going to be financed with equity or stocks? And so then that's capitalization. There's total capitalization, which talks about both the amount of stocks you have and the amount of bonds, or there's market capitalization, which tells you how much is in the stock market in that particular company, like how big are they relative to the other players? And so we were once affiliated with this organization here, LPL Financial, and let me find it here. Let me get my marker. According to this source, LPL Financial, their market capitalization, that's if you take every single share of publicly traded stock.
Looks like there's a bunch of them.
And if you took every share and multiplied it times the stock price, that's what capitalization, market capitalization. If you want total capitalization, you'd have to go out and add to that $20 billion number how much they have in loans. And then I'm giving you a more complicated explanation, but bear with me. There's a ratio that people used to look at to see how good a quality a company is. It's called debt to equity. You would take how much of your capitalization is debt, how much is equity, and people would compare that to see what quality a company you are. I think Exxon Mobil was the one we've talked about a lot, that they're pretty much 100% equity. They were. I haven't looked at it.
I haven't looked at their balance sheet in a long time. I used to love to look at that.
Yeah, that's
They
squirrely.
They didn't play around.
Yeah.
I mean, their balance sheet was squeaky clean.
And that's kind of counter culture in our not only in our business economy, but a personal economy. Like, people don't consider debt a issue much anymore, and they lean more heavily into debt. But so that's how you get to capitalization. You multiply the share price times the number of shares, and it gives you a number. That one was right at $20 billion. And then in the industry, they break it down between micro cap, very, very small companies, small cap companies, then mid capitalized companies, and then large or mega cap stocks. I don't know who the largest is. Is it it's one of the Mag 7 that's $1 trillion companies, but $1 trillion compared to 20 billion is quite a difference. And a $20 billion company is huge. Like, we were affiliated with it, and a $20 billion company doesn't even know who we are. That's how big a $20 billion company is, which is the data I looked at, Doug, said a mid-sized company is 2 billion to 10 billion equity. Is that the number you saw?
I mean, that's reasonable. I always just look for 5.
Yeah.
You know,
Yeah, that's about the mid range, was 6, 5, 6. So then there's all kinds of companies mid cap. Then there's smaller that are still huge companies, and then those micro companies. But the reason these things even exist is one day somebody had a business. Todd Robinson started LPL Financial, and he had such success with it that it got so big, he got so wealthy, he didn't have an estate plan for his family to transfer the wealth. And so he needed to bring it to the public markets to have a way to transition his company for the long-term benefit of his family. So he had to sell shares in what's called an initial public offering. And then that is how they got to the marketplace and became a publicly traded company. And he is the originator of the idea out of the company. And that's where a privately owned company becomes publicly owned, mainly for estate planning.
That's a great example of the why. Why does a stock exist? Why does a small company stock exist? That could be it. Is it it's estate planning?
Yeah, I assume that's how most of them got there.
It could be there's private equity. We're seeing more and more of that today, where there's private equity that's built into a company along the way. And then all of a sudden the private equity says, hey, look, we're looking for that multiple. I think we've hit it. Let's take it to the market. Let's sell this to other shareholders. And so it becomes a liquidity event now for the private equity firm. So liquidity could be an estate. It could be private equity. It could be just the group of shareholders like, hey, we want to do something differently. We want to start another company. At multiple reasons, but this is what gets me excited about this space. The bonds, it's just kind of interesting based on the time where we are. That's why I'm intrigued by it. But this is the heart of the matter. Okay, how do we get ahead of the printing that was done when the government shut down businesses during COVID. How do we come back as a country? It's innovation. It's doing things differently. And by these smaller companies coming to market, what does it do? It gives us the opportunity to be a part of it. It creates ownership opportunities for someone like me. It creates scalability for people. You know, if you had money and you wanted to do something with it, yeah, you could take it to the bank and buy savings. You could buy a money market like we discussed. It'd be pretty hard to buy a couple businesses. But if you could buy something like a small cap index or a large, whatever it is, if you could put it into the market, it's scalable at this point, meaning the market's so big, you can participate and have give me my money access. That's what excites me about the small caps. They're my favorite space to look at.
And one of the things that also goes along with all those other things they do is that's probably where future employment's coming from. And let me say it this way, is that it is a mountain. Like you go up the mountain and become a mega cap or large cap, and then you come down. And that's the life cycle of a business. So you can't be a large cap unless you continue to have success. It's impossible to do that. But the success of a large cap will come down when they get complacent, they incorporate I forget what all these political correct things is.
Like ESG.
Yeah, all that. I'm a believer all those things will be self-correcting because you waste profits doing those things. And eventually the younger, smaller cap ones are like, we don't have to do those things, but we're going to come up and eat their lunch. And so a micro, small, mid cap, all of those could be on either side of the triangle. The large is you hit the top and you can only go down from a large cap. So just because something is a mid cap doesn't mean it's the right one, because it could be on the way down from being a large cap to mid cap to small cap, because that's what happened to Enron. Enron was at the top. On their way down, they became a mid cap, a small cap, a micro cap, and then no cap.
I was so ticked off of Berkshire Hathaway a couple years ago. And you guys probably know Berkshire Hathaway, that's Warren Buffett's company. I was so ticked off because they're so successful. And they bought one of our small companies that we owned and you owned as clients, and they saw an opportunity there and they purchased it, and I don't blame them for purchasing it. But that's another thing that happens with these smaller companies is they get acquired, and they are constantly having to deal with offers from other people coming in and saying, hey, would you like to join our team?
Right.
And that's a little more difficult for an Apple to have an invitation to join a team. And so that's another reason why I like that space.
Well, we have talked a lot about two big deals, bonds and companies and their capitalization, and we have not talked about the current market, and we're about out of time. Doug, do you have anything you want to say about the current market?
We're still in an uptrend. I mean, when you look at the long term, just even going back to this past fall, we still look pretty good. We've pulled back, and yes, that is concerning and something to pay attention to. But overall, I think the picture looks pretty good. On my stock almanac, it shows that we've entered into like a seasonal time, where that season historically, according to the numbers of the past, say the market is best November to April, and then cools, and everybody goes to I don't know where people in
Long Island.
They go to Long Island and vacation from April to October, but you never know. And so we just want to stay attuned to the market. We want to listen to the market. Mr. Market's always right. And so that's where we want to be right now.
And this month's the May anchor will explain a little bit about that, where we talked about the idea that a lot of people say sell in May and go away. So stay tuned to that. We'd be curious to your feedback.
Yeah, check that out. And if you have some feedback on it, we'd like to hear it.
All right, Doug, enjoy your weekend and wear that hat. Be careful out there. See you guys real soon.